Welcome to the deep dive. When a huge company like Hyatt puts out its quarterly results, you often see these big, shiny headlines.
Yeah, but they often miss the real story, don't they?
Exactly. The true picture, the health and the actual strategy. That stuff's usually buried deep in the footnotes, hidden behind all the acronyms.
And understand the difference between, say, GAAP and non-GAAP accounting.
Yeah.
That's crucial.
Right. So we're not just doing the press release version today.
No way. Our mission here is really to get under the hood, analyze the operational thesis of the whole company. We're doing a deep dive into Hyatt's Q3 2025 results.
And maybe more importantly, looking at how this massive strategic shift they're making, becoming more asset-light, really brand-led, how that's actually showing up in the numbers.
We've been digging through the financial reports, the earnings releases, all those forward-looking statements, the raw stuff.
And for you listening in, the goal is to get a really solid grasp of where this hospitality giant is heading, especially how this fast-paced strategy buy brand, then sell the assets off, how that impacts things.
Both the short-term profits and, the long-term fee income.
Okay, let's dive in. Let's start with the core operational health in Q3 2025. That classic hotel metric, RevPAR revenue per available room.
Comparable system-wide hotels, RevPAR.
It saw a pretty modest increase, 0.3% compared to Q3 last year, adjusted for currency.
Yeah, 0.3%. It sounds small, but it tells you the day-to-day engine filling those rooms, it's steady, stable.
But maybe not the main growth driver right now.
Well, it shows stability. But you're right, the strategy isn't really about maximizing daily room revenue anymore, is it?
No, it feels like it's all about the fees. And if you look there, the picture changes quite a bit.
Definitely. Gross fees. So management and franchise revenue jumped 5.9% to $283 million.
Okay, so 0.3% RevPAR growth, but 5.9% fee growth.
Right there. That gap kind of tells the whole story of their strategic pivot in one comparison. They want to grow the network, grab those management fees, owning the actual hotels, less of a focus.
And then there's Adjusted EBITDA, that non-GAAP number management really focuses on internally.
Crucial metric. It was up 5.6% to $291 million.
But there's a footnote there too, right, about asset sales.
Exactly. You have to read the fine print. If you adjust for the assets they sold back in 2024, that Adjusted EBIT growth looks even stronger. It jumps to 10.1%.
So the core profit engine is running pretty efficiently.
It is. But here's the twist, and this is pretty typical when a company's doing major surgery on itself.
Okay.
Despite the strong fees and that adjusted profit growth, Hyatt actually reported a GAAP net income loss. Attributable to the corporation, it was $49 million.
Wow. Okay, so diluted EPS of -$0.51.
Right?
That sounds jarring. How do you get strong adjusted profit but a net loss on the books?
Well, that GAAP loss is basically the upfront cost of this big transformation. It includes huge charges for things that aren't core operations.
Like what?
Think massive transaction costs, asset impairments, integration expenses, all tied to buying these big portfolios and then setting them up for sale.
So the fee business is healthy, but the act of transforming is expensive right now.
Exactly. Short-term pain for what they hope is long-term gain.
Got it. Okay, going back to operations for a second, what specific areas kept that RevPAR ticking upwards, even if just slightly?
The sources point pretty clearly to two things, luxury and leisure.
Ah, the high end?
Yep. Luxury chains drove the RevPAR growth in Q3. And leisure transient RevPAR, people booking individual trips, that was the strongest area of increase. High-end travelers are still spending.
Makes sense. And there was one other little detail, a timing thing that nudged the numbers slightly.
Yeah, this is fascinating for anyone trying to model this stuff quarter to quarter. Group RevPAR growth, it was actually hit by about 100 basis points negatively.
Why is that?
Just the timing of the Rosh Hashanah holiday. It fell in Q3 this year, but last year was in Q4.
Ah, so shifting group bookings between quarters.
Exactly. It's a minor point overall, but it shows you how these little calendar shifts can impact the quarterly comparisons. Important detail. Okay, that level of detail really underlines their focus. And speaking of focus, nothing screams growth area for Hyatt right now, quite like their huge push into all-inclusive resorts.
Oh, absolutely. This is where the aggressive expansion is really visible. Overall, net rooms growth, system-wide, was up 12.1%.
That's massive growth.
It is. And even if you strip out the rooms they acquired, the organic growth was still 7.0%. So they're expanding across the board, but all-inclusive is definitely a star.
How strong was that segment performance specifically in Q3?
Really solid. Comparable system-wide all-inclusive resorts saw their net package RevPAR increase by 7.6%.
Okay, 7.6% is strong. Any specific brands doing well?
Yeah, they highlighted the Secrets Resorts and Spas brand. Its net package RevPAR was up 7.1%. So that luxury leisure all-inclusive combination, it's clearly clicking for them.
Which brings us right to the big one, the thing really defining this Q3 report, that huge Playa transaction.
Yes. If you want a textbook example of the asset-light model in action, this is it.
Walk us through the timeline, because it sounds like it happened incredibly fast.
Blazing fast. It shows the speed this strategy requires. So June 17th, 2025, Hyatt closes the deal to buy Playa Hotels, big owner-operator of all-inclusive resorts. Enterprise value around $2.6 billion.
Okay, so they buy everything: land, buildings, operations.
Yep. But the asset-light playbook says you don't hold on to the real estate for long.
Right. So when did they line up the sale?
Less than 2 weeks later, June 29th, they announce a definitive agreement to sell the owned real estate portfolio, 14 properties, to someone else for $2 zillion.
Wow. Buy for $2.6 billion, line up a sale of the property for $2.0 billion almost immediately.
That's the model. Keep the management contracts, sell the bricks and mortar.
Now, the sources mentioned some technical terms around that $2.0 billion sale, like preferred equity investment and contingent consideration. What does that mean for you, the listener?
Yeah, good question. It basically means it's not just a simple cash handover for the full $2 billion up front.
Yeah.
Accepting preferred equity means Hyatt is kind of financing part of the deal for the buyer, but they get paid back first before other investors. It helps seal the deal faster.
And the contingent consideration.
That means some of the payment might depend on future performance or hitting certain targets. It just structures the deal to get it done quickly, lets Hyatt lock in the management agreement, even if the full cash takes a bit longer to come in.
And we saw this machine already working in Q3, didn't we? They sold off one smaller Playa property.
They did. One in Playa del Carmen sold for $22 million. And those proceeds immediately used to pay down some of the debt they took on to buy Playa in the first place.
Cash in, cash out, high velocity.
Exactly. And that rapid recycling of capital is the absolute core of their philosophy, the asset-light model.
So let's talk about that goal. They've put a number on it, aiming for an asset-light earnings mix of 79%.
Yeah, that's the big target.
Where were they before this big push, roughly? And why is 79% such a magic number for them?
Well, historically, Hyatt was much more balanced, maybe closer to 50-50 owned hotels versus managed franchised fee revenue. Hitting 79% means nearly 4/5 of their income would come from those stable, higher margin fees.
Minimizing the risk and capital tied up in owning actual buildings?
We have to. Less exposure to the ups and downs of the real estate market, less need for huge capital expenditures. Those asset sales, like the Playa deal, are basically the fuel needed to get to that 79% mix. They expect to get that $2 billion from the Playa property sales done by the end of 2027.
But buying something for $2.6 billion, even temporarily, requires serious cash up front. We saw their total debt climbed, right, to $6.2 billion as of September 30th.
Right, and a huge chunk of that increase was a specific type of loan, a $1.7 billion delayed draw term loan facility, or DDTL.
DDTL.
That was used specifically to finance the Playa acquisition initially.
So for listeners, how should we think about a $1.7 billion DDTL? Is it sort of like a specialized bridge loan?
That's a perfect way to think about it, yes. It's flexible, temporary debt, designed precisely for this kind of buy-then-sell strategy.
And the key detail?
The critical detail is that Hyatt has explicitly said the $2.0 billion they expect from selling the Playa real estate is earmarked specifically to pay back these DDTL loans.
So the debt comes in, funds the purchase, and is expected to go right back out once the real estate is sold.
Exactly. It's designed to be short-term financing for the transition.
Okay, all this strategic maneuvering, buying and selling, makes it really important to understand how management talks about performance. We have to touch on those non-GAAP metrics again, like Adjusted EBITDA, especially when the official GAAP numbers show a loss.
You absolutely have to look at Adjusted EBITDA if you want to understand how management sees the business operating day-to-day and how they're measured.
Because it's a key metric for them internally, for performance, maybe even compensation.
Precisely.
Yeah.
They use it because, in their words, it strips out items that do not reflect our core operations.
It's meant to remove the noise of the big strategic changes themselves. So what are the big things getting stripped out right now that really matter for understanding this?
Well, you have the standard stuff like interest expense, depreciation, amortization, but the huge one right now is transaction and integration costs.
The cost of doing the deal.
Yeah, and they are massive. $130 million just year-to-date in 2025, almost all tied to buying Playa, integrating it, and handling the complexity of these giant buy-and-sell deals.
So if you didn't adjust for those costs, the underlying profitability would be completely hidden by the transformation expenses.
Completely obscured. That's why they use Adjusted EBITDA to show the ongoing operational health.
Okay, that makes sense. Let's look ahead then. Moving past Q3, what did the company actually guide for the full year 2025?
All right, looking at the full year picture, and this is important, it excludes the impact of selling off that Playa real estate. Later, the outlook suggests consistent fee growth.
Okay.
They're projecting comparable system-wide RevPay growth to finish the year somewhere between 2.0% and 2.5% compared to 2024.
Still modest growth on the RevPayer side. What about that key management metric, Adjusted EBITDA?
They're projecting that between $1,090 million and $1,110 million.
Which represents what kind of growth?
That's about a 7% to 9% increase, again, when you adjust for the assets they sold off previously. And they're also still forecasting strong organic growth in rooms outside of acquisitions, ending the year between 6.3% and 7.0% growth.
So the core expansion engine is still running strong.
Seems so.
And are they pulling back on returning cash to shareholders given the temporary debt jump?
Doesn't look like it. They projected about $350 million in total capital returns for the year.
How are they doing that? Dividends, buybacks?
Both. They declared a $1.15 per share dividend for Q4, and they still have a lot of authorization left for share repurchases, about $792 million as of the end of Q3.
Okay, now looking even further out, beyond 2025, the CEO highlighted something interesting, a growth driver that isn't strictly about hotels, the loyalty program.
Yes, the loyalty engine. This is a really important insight into how they're diversifying where their fees come from. They specifically mentioned an expanded agreement with Chase for the World of Hyatt credit card.
Right, the co-branded credit cards. That feels like it could become a pretty significant non-hotel revenue stream. How big could that actually get?
Well, according to the source material, the financial impact on Adjusted EBITDA just from the credit card programs and similar partnerships, it's expected to more than double between 2025 and 2027.
Wow, double.
Yeah. That points to a really valuable income stream that's not tied to whether a specific hotel room is full on a Tuesday night. It's tied to the brand strength and how much people value that loyalty program.
Okay, so let's try and tie this all together. We've covered a lot. What's the main story for you listening in?
Well, Q3 showed, modest operational growth in RevPAR, but it was clearly pushed by high-end leisure travelers and that booming all-inclusive segment they're betting big on.
But the overarching financial narrative.
The dominant story is definitely this high-cost, high-speed strategic overhaul. They're taking a hit to their official GAAP income right now because of these huge transaction costs.
All to get to that cleaner, higher fee, asset-light model down the road.
Exactly. Sacrifice short-term GAAP for long-term fee stability and growth.
Which leads us to, I think, a really interesting final thought for you to consider as you watch this unfold. This whole asset-light strategy depends on these massive, incredibly fast deals. Buying Playa for $2.6 billion, lining up the $2.0 billion property sale almost instantly. It raises a critical question for the next few years. If the company becomes so hyper-focused on maximizing fees and minimizing ownership risk through this constant buying and selling of the actual hotels, how does that rapid-fire real estate shuffling ultimately impact the guest experience? Does the quality and stability of the World of Hyatt brand feel consistent long-term?
That's the fundamental tension, isn't it? Balancing what shareholders want, efficient fee generation, with what guests expect, a consistent, reliable brand experience. Every hotel company going down this path has to figure that out.
Definitely something to mull over as you track Hyatt's progress into 2026 and beyond. That was our deep dive into Hyatt's major strategic shift. Thanks for joining us.